Welcome to Investing Insights. I'm your host, Ivana Hampton. The U.S. auto industry is driving on a bumpy road. Automakers are dealing with chip shortages, stubborn inflation, and high interest rates. Car buyers are seeing eye-popping sticker prices, and it's costing them more to borrow to buy a car. Right now, the industry is sitting at a fork in the road. Morningstar Research Services, U.S. Autos equity analyst Dave Whiston, has written about the industry's outlook. Dave is joining Investing Insights. Dave, you and other analysts put together a big report on the auto industry each year. What are this year's themes?
Well, 2023 obviously is a year of great uncertainty for a number of reasons, but it's both good and bad, honestly. For a global sales forecast, we're looking for a range between down 1% to up 3% year over year versus 22. The U.S. market is choppy and recovering from the chip shortage, as is the rest of the world. In China, you've got the expiration of EV incentives. Everyone's battling high inflation, of course, and rising interest rates. And then over in Europe, of course, you've got massive uncertainty from the war in Ukraine.
Well, let's look at the chip shortage. Fewer cars rolled off the assembly line last year, and sales fell to their lowest in years. Talk about where inventory stands now and maybe in a few years.
Yeah, so I'll just stick to the U.S. market because that's my area of coverage. But U.S. light vehicle inventory has really been on a huge roller coaster since the pandemic started in March of 2020. Initially inventory was getting hurt for a while due to no production in spring 2020. Things started to recover in the back end of 2020, and then we went to and then the chip shortage started to really hit in early 2021. So putting some numbers behind that story, basically right before the pandemic, we were right around, I believe it was right around 4.1 million units of U.S. light vehicle inventory. And then by September of 2021, we were all the way down to 973,000 units for the whole industry in the U.S. We're now at about 1.7 million, just a little over 1.7 million. So we've been going up, and that's great. I want to say we're up, I believe, 7 straight months now, but we've got a long way to go. Automakers aren't going to go back to pre-pandemic levels because they want to keep pricing healthy. We've seen that with their financial results the past few years too. Overproducing is the way to go, and I think the industry finally gets that. But at the same time, they know current levels are too low. The chip shortage, I think, will take at least through the end of 2023 to resolve itself. Probably at some point in 2024, we'll finally get to stop talking about it. But 1.7 million, like I said, is too low, and exactly where we go, and I think that remains to be seen. But my prediction is probably something in the either very high 2 millions to low 3 million range is ultimately where we'll get, but that won't be in 2023.
Now, which automakers took the brunt of this inventory drop?
Yeah, I mean, the chip shortage has hurt everybody. It's hurting everybody kind of at different times and in maybe different magnitudes. I think initially in 2021, especially, it was much more of a Detroit 3 problem. I covered GM and Ford, for example, and it really hurt on their pickup truck inventory, especially Ford initially. And Ford had a lot of exposure to the Renaissance chip maker plant factory fire in Japan back then. And then we found out that actually Toyota isn't all that quite as lean as we thought. They do stockpile inventory, and that helped them quite a bit when the chip shortage first started. But eventually, their reserves did run out. And in 2022, everyone was hurting from the shortage, but I think the Japanese automakers got hurt more. And there's some interesting data points just to think about here, especially, and this matters for U.S. auto sales because the Japanese dominate the crossover segment, and crossovers are a little less than 50% of all new light vehicle sales in the U.S. The Honda CR-V, for example, its sales were down 34% last year. Its inventory was about 14,000 units before the pandemic. At the end of that would have been the end of 2019, it was 71,000 units. Another interesting data point to think about is Group 1, one of my dealers, are based in Houston. They have stores in a lot of parts of the country, and they had a really interesting data point on their third quarter earnings call back in late October. They talked about their largest Toyota store. They said normally before the pandemic, that store would have 1,000 Toyotas on the lot to sell. And at that time in late October, they only had 7. So they went from 1,000 vehicles to just 7 vehicles to sell at that store. So that just shows you the magnitude of how bad things have gotten. I do think as long as things don't get a lot worse in terms of supply chains, I think the chip shortage, the worst of it is past, but it's going to be a lumpy recovery. It's not going to be a smooth upward line. There's going to be some months where maybe inventory doesn't go up that much or maybe even goes down a little bit. But the overall trend throughout 2023 and into 24, I think will be upward.
Well, as you mentioned, lots had a lot of cars and then they stopped having a lot of cars. So those new car buyers, they started heading towards used car lots and used car prices soared. When are those prices expected to come down?
Yeah, there's a whole dynamic on the chip shortage that goes beyond new vehicle sales, which is the used market, and used is ultimately a function of what's going on in the new market, because there's no used car factory. You don't crank out used cars to manufacture. It's all a function of new vehicle sales and the off lease volume, and a new vehicle lease is generally 3 years. So basically, the pattern in used vehicle pricing, it was actually interesting to see when you look at things like the Manheim Used Vehicle Value Index. History really repeated with 08, 09, and that initially when all the panic set in from COVID, just like when Lehman first collapsed, pricing and demand all collapse and the index goes down. But very quickly, used vehicle prices start to skyrocket, and that's because used vehicle supply starts to thin. And it got really bad, of course, initially in 2020, as I mentioned, with new vehicle production stopping in the spring that year. But then when the chip shortage starts happening, used vehicle pricing at that point really accelerated to the point that the Manheim Index got to an all-time high in January of 2022. And it got so bad to the point, honestly, that you had the rental car agencies, for example. My dealers were complaining about the rental car fleets going into auctions and buying up used cars because they couldn't get their normal new vehicle allocation from the automakers. And then of course consumers, they're seeing new vehicle pricing get high, so they want to buy used too, but the supply gets thin, the demand for used is high, and that just caused pricing to go up even more. In 22, the Manheim Index did decline, I believe, eight months out of 12 months. Lately, though, it has gone up the past 3 months, and some of that I think is inflationary pressure, and some of that is also the spring and the first part of the calendar year is a peak demand time for used cars because of tax refund season. So I'm expecting / hoping that even though we'll still have inflationary pressures, the used vehicle pricing will improve throughout 2023 after the tax refund season, but also as new vehicle supply continues to increase as the chip shortage improves. That should help the market. I hate to use the word get back to normal because there doesn't seem to be a normal anymore in autos. There's always something going on, but things should get healthier and more reasonable relative to where they are now in early 2023 and the pricing we've seen on used vehicles in 2022. But as of now, pricing is still about 50% higher on a used vehicle than it was before the pandemic. And honestly, I don't expect it to go back to pre-pandemic levels because, again, there's no used car factory, right? So the used vehicle supply in terms of the off-lease supply, that's already set in stone for the next several years because a vehicle that, say, would have been bought new as a lease in, say, June of 2020, that vehicle is not coming off lease in June of 2023. That used vehicle, it will never exist, and you can't make that up. All you can do is start to improve things going forward. So used vehicle pricing, I think it will get better. But it's going to stay elevated relative to what people are used to, and they're just going to have to accept that and then decide when they want to buy.
And I believe you touched on this a little bit, but what's the recommendation for car buyers since we are in a seller's market?
Yeah, it's funny you asked that because I actually have wanted to buy a car myself since the pandemic started, and I'll keep my comments high level here because I'm a stock analyst, but it's in my opinion, it's not a buyer's market. I think if you want to buy, you're going to need to prepare to pay up. Inventory's tight, whether you want new or used, and you may not necessarily get the selection you want. I mean, that's why if you can wait, it's probably better to wait. I personally am waiting because luckily, we still have another car that works, but not everyone can do that. My father got in an accident, for example, a couple of years ago during the pandemic. He had to get a new car, and he waited a bit, but it worked out.
And what's the trickle-down effect on leasing?
Yeah, so leasing has gotten pulverized in terms of its mix of new light vehicle sales. Before the pandemic, it was right around 30% of all new light vehicle sales in the U.S. Were from leasing. That ratio got all the way down to 19% in 2022. It was the lowest level since I believe 2012. And in the fourth quarter of last year was actually 17.2%, according to Experian data. So basically, that's a function of a few things. One, the biggest issue is just not enough inventory. So what inventory they have, I think automakers are pushing, and the dealers are pushing people to buy rather than lease. The vehicles that are getting produced are also more expensive, and it's bringing people who are more able to spend a lot of money, frankly. And so they're buying these, on average, nearly $50,000 cars across the industry, which is too high of a price and needs to come down. But I think automakers ultimately want to get leasing up because it creates a more consistent traffic flow for your dealers, because a lease is generally 3 years, and that means every 3 years that customer is going to need another vehicle. But in terms of it coming back to 30%, that's probably not happening anytime soon. That'll take a number of years. And perhaps maybe we don't ever get there. I've heard dealers say in the past that some of them say they would rather it not be 30%. They'd rather see it be more like 20%. So maybe it only gets up into the low to mid 20s over time.
Well, the Federal Reserve started raising interest rates in March 2022 to fight inflation. Borrowing costs have gone up. Could we see an auto bubble, Dave?
Well, I've been of the opinion for a long time that there is no subprime lending bubble in auto loans. I know people like to make comparisons to the mortgage crisis and whatnot, but it's not really the same thing. The collateral profile between a house and a car is very different. So yes, you can extend loan durations on auto loans, and they have been creeping up over time. Although in fourth quarter they actually were down a little bit. I think it's like 69.4 months on average now versus 69.6 months or something. But going to say a 30-year auto loan, that just makes zero sense because of the collateral profile in question, and the lender would have to be, I think, very foolish to write 30-year paper on a car. So will the duration go up? Probably, to help manage some payments. Sure, but maybe you're creeping into the low 70s to mid 70s over time on average. There are 84 and even 96-month car loans out there, but it's not a huge mix. But going to like a 10-year, 15-year, 30-year auto loan, to me, that just doesn't make any sense. Also, if you look at the New York Fed data, looking at the credit scores on originations every quarter, the credit score is below 620 as a mix of overall auto loan originations. It's now currently about 15%. Right before, in the years before the Great Recession, that same mix was double, almost double. It was in the high 20s. So to me, and lately what I've been hearing and seeing in data too is that subprime lending is pulling back on autos, and some people might sound alarm bells on that. I haven't heard about credit getting contracted more broadly. So for now, and to me, it looks more like responsible lending than any kind of credit bubble. And like I said, the mix of subprime is down. So I think lenders are trying to protect themselves. They probably did write some bad paper maybe the past couple of years. 30-day delinquencies are rising. That hasn't hit 90-day delinquencies yet. We'll see how bad it gets. But I'm not. What happened in 08, 09, I think was definitely not a normal recession, in my opinion.
Well, talk of a recession has been going for a while now. Dave, you wrote that the auto industry already had theirs. Can you explain?
Yeah, and I'll just put a qualifier here at the beginning and say I'm not saying auto sales are immune from a downturn or recession should we have one in 2023 or 24. But this is not a normal cycle that we're dealing with for auto sales. So in 2020, I believe sales were down over 14%. They were up about 3% in 21, and in terms of year over year. And then last year in 22, they were down, I believe, almost 8%, if I remember right. It was the worst year since 2011 last year for U.S. auto sales. So basically, what I like to do is go back and look at a lot of historical data and put sales into terms of per capita terms. You look at I've got the data going back to 1951. The per capita ratio in terms of sales, in terms of the total U.S. population in 2022 was 4.1%. It was 3.4% in 2009 when we sold 10.4 million vehicles. We did about 13.7 million last year for perspective. And then the average for this per capita average for this century since 2000, it's 5% even. So if you then take some recession years like 1982 or 1991, and then apply per capita math to the current population and 2023's population, depending on which ratio you use between 82 and 91, you would get sales of either in the high 14 millions to low around something like 16.3 million. So for perspective, that's 1 million to over 1 million to about 2.5 million more units sold in a recession than we sold in 2022. So now, yes, the chip shortage is still out there. That may prevent some production. So it kind of depends when the recession were to hit, should it hit, of course. But again, I don't think it would be as bad as 2009. That's just my own personal opinion. We have macro people you can interview later to do recession takes, but it's a really mixed bag in my opinion, macroeconomically speaking. You've got inflation, higher rising rates, but at the same time, you've also got tremendous demand still for services like travel. And outside of the tech industry, the labor market still seems pretty tight. So when you look at, again, looking at that per capita sales I'm talking about, that's what leads me to believe and say something I would never normally say, which is that should we have a recession even this year, I think auto sales will still go up year over year. Normally, I would never say something like that because normally the auto sales cycle, basically you're starting high, things are going great, and sales are really good, and then various macro things happen and whatnot, and sales tank. Well, that didn't really happen. It didn't happen that way in this cycle because things were going along in very early 2020, and they were reasonably okay, certainly better than they are now. And then we had the pandemic hit, and then sales already went down, and then they as I said, they only went up 3% in 21 versus 2020. So we still haven't recovered yet from the downturn we've already had. So and 2022 sales levels, honestly, to me, they weren't just recessionary, they were deep recessionary. So if we have more of a mild recession, I still think there's potential for potentially even 15, 16 million units sold in this country. And after the way the auto supply chain has cut costs, and also given what the auto industry has dealt with the past few years, everyone would be ecstatic to get 16 million units right now.
And I believe you touched on it in this previous question, but where can the U.S. auto industry go from here?
Well, I am looking for sales to go up this year. I'm looking for a little bit north of the mid 14 million range for 2023 in the U.S. And as I mentioned at the beginning, global, we're looking for down 1% to up 3%. I think the takeaway I would give to clients is that the recovery is going to be lumpy. It's going to be choppy. I'm talking particularly about the chip shortage. It's going to vary by automaker in terms of who's getting hurt or not getting hurt at any given time throughout the year on chips, and how much can that help you get back. I mean, look at Ford and GM last year. Everyone thought GM was crazy with their wholesale unit guidance of up 25 to 30%, but they delivered on that. Ford was I believe more of a high single digit number increase, if I remember correctly. So you're seeing splits there, not just between GM and Ford, but also between the Japanese automakers and other automakers too. So it's going to be up and down, hence the word uncertainty I used to start our discussion today. But I do think the overall direction over time will be up because we've already had severe recessionary sales levels for U.S. autos for several years now.
That was part one of Where Can the Automotive Industry Go From Here? Part two will focus on the shift to electric vehicles. Dave will also discuss his stock picks, including one that's rarely on sale. Thanks to Dave for his insights on the economic environment's impact on the auto industry. And I'm thanking lead technical producer Scott Halver and senior video producer Jake Vankerson. Subscribe to Morningstar's YouTube channel for new videos from our team. And I'm your host, Ivana Hampton. I'm a senior multimedia editor here at Morningstar. Take care.